Investors are really having a tough time digesting what the Fed has just said in their latest FOMC meeting. Jerome Powell came out with a 25 basis point rate hike, and investors are now questioning whether this is a sign of them making yet another policy mistake, or if inflation is actually coming down according to plan and potentially signaling a soft landing, because clearly right now we're not in a significant recession. That question is exactly what I want to address in this video, along with busting some myths regarding the macroeconomics of inflation and interest rates that seem to be floating out on social media way too much and misleading many investors. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, I think it's safe to say that there was nothing big of a surprise in the FOMC delivery yesterday. There was obviously a lot of hype going into it, but it was pretty clearly expected by the market participants, a 25 basis point hike. And why that is the case? Well, because inflation's actually coming down, unlike what many people want to believe in the stock market. We peaked at 9.1% back in June of 2022, and even though the Nasdaq ended up bottoming around October of 2022, as you can see, we have fallen off a cliff to 6.5% in December of 2022. This is what the Fed job actually is. This is what they wanted to do with their first interest rate hike back in March of 2022. When people saw this inflation actually go up throughout April, May, and June, people thought we're going to go into this stagflationary environment like we saw in the 1970s, where whatever the Fed does is not going to have an effect on what's happening in the economy. But little do people know that interest rates actually take some time to work through the economy, and it's typically a 6 to 9 month lag before you start seeing effects on demand, which is going to bring down the CPI inflation rate. And fortunately for investors, that is exactly what we're seeing happening. This is the entire reason the 2-year yield peaked back in October and November of last year. People are in disbelief that interest rates would be cut in 2023, but based on the path of inflation, there's a really high likelihood that it does happen, because the Fed's job is not to throw us into a deep recession. Their job is to bring down core PCE to 2%. As a matter of fact, markets on the 2-year and 10-year yields are pricing in that by the end of 2023, we should see the Fed funds rate actually see one cut instead of just all rate hikes. As you can see, we have around 8 meetings to go throughout 2023, including the one we just happened yesterday. And market participants are pricing in a 33% chance that we're going to sit at around 450 to 475 basis points by the end of this year, which would mean a cut from 25 basis points. But I don't want you guys to be fooled. This is something that could have been predicted 12 months ago since the start of this tightening cycle. If you actually looked at the leading indicators of inflation, whether that be oil prices, 5-year break-even rates, supply chain related issues, inventories going up, you'd understand that inflation is not supposed to be a sticky situation. It was a short-term influx induced by stimulus checks and quantitative easing in 2020, which is overdone by the Fed based on a pandemic that turned out to not be that significantly affecting the economy. We saw remote work, we saw GDP rebound, and as a result, it was difficult for the Fed to pivot their stimulus check programs, which obviously would have recited a lot of backlash. And guess what? When people have stimulus checks to spend money on, they're going to go spend money on products that probably they could not be able to afford otherwise. That led to heightened demand for companies, bigger profits, bigger margins, more hiring. And right now we're just seeing a reversal of that to the mean. And why does that matter? Well, because one of the key things Jerome Powell said in the FOMC was that the labor market is still relatively tight based on the job openings data we're seeing, but inflation is actually coming down. And this is a big shift from what we've seen in the tone from the Fed, because he initially thought that an increase in the unemployment rate is what we needed to bring down inflation, meaning both of those were mutually exclusive. They would all need to happen in contrast of each other. But the recent data since October is showing us actually a tight labor market is not driving inflation. It's pretty obvious that even if we're seeing tech layoffs, The unemployment rate isn't going up that much, and job openings are still growing, but inflation's still coming down. And I hate to break it to all the bears and the shorts, but this is the definition of a soft landing. Now, there's obviously uncertainty. There could be different changes in macroeconomics, politics, and geopolitical situations this year that could throw off the course of inflation, the Fed's interest rate path, and the situation with the economy. But based on the given data that we have today, which is exactly what we're supposed to analyze as stock market investors, it looks like to me we are on the right path to fighting inflation. And the stock market has most likely bottomed. And well, why exactly do I believe that? Well, if you look at what's happened with Meta stock, it paints a really important picture for what's actually going on in the entirety of Wall Street over the past 6 months, as many retail investors are panic selling into the fear and also taking profits in any single rally that we see throughout this bear market. Meta stock was one of the most hated companies of 2022. People were thinking this company is going bankrupt, even if they have literally 3 billion people using their apps. I was personally an investor in Meta, and I still am, and I did average down throughout the entire drawdown that we saw in 2022. And I'll be honest, it was not that easy to do. It was pretty difficult to see how the metaverse was going to play out, but I maintained my conviction, and now the stock is up over 120% and up almost 20% after it reported a revenue and EPS miss last night. This is a sign of markets realizing the undervaluedness of equities in the short term. Even if financial conditions have worsened and fundamentals for companies like Meta have gone down, at some point the pain is too much. There is a bottom that is going to take place, even if the news is still bad. This is what the market's supposed to do. It's supposed to design majority of the people, and it's supposed to look ahead 6 to 9 months. And that is exactly what Meta stock, for example, has done since its lows on November 2nd. And this leads me on to probably the biggest misconception that's floating around on social media, which is this idea that financial conditions are loosening just because stocks are up 30% in one day. I hate to say it, but Aunt Karen is not going to start spending more money at Market Basket for her groceries just because Carvana stock is up 33% in one day. This is where the big misconception starts, because people are thinking that just because the stock market is rallying in the short term, that inflation is potentially going to start getting loose again and the Fed's work is going to get undone. I hate to break it to you, but that's not really how the market works. Aggregate demand is what drives inflation. And aggregate demand is affected not only by the wealth effect, but 3 other major factors. The main driver of inflation is driven mostly by the net export effect, real balances, interest rates, and inflation expectations. They aren't driven by what's happening in the stock market in the short term, or hell, what even the real estate market's doing. The only reason why this wealth effect phenomena exists is because in the latter stages of a long-term bull market, when stock prices are at all-time highs and real estate prices are up significantly, people tend to feel wealthier. That leads to this compounding effect where people start spending incrementally more money every month on their budget, or buying properties, or buying consumer devices. Just because stocks are up 20 to 30% in the growth sector and the index is up 2% in one day doesn't mean all of a sudden people are going to spend more money, and that's going to cause inflation to skyrocket. This is just not how the economy works, and I think this is a lot of misleading information around this floating on social media. And this leads me on to the second idea that I think many people are completely misunderstanding on social media, which is this idea that just because the US job market is still increasing, the market in the equity space has more downside because all of a sudden the Fed's going to have to raise interest rates even more than it already has. I hate to break it to you, but let's be honest, the US job market is broken into 2 main parts, and unfortunately the stock market only cares about one of those. And that happens to be Wall Street. As you can see, Main Street is quite different from Wall Street. Wall Street includes your big tech companies, your Googles, Spotify, Amazon, Microsoft, and Facebooks. Those companies have laid off workers. So the tech unemployment rate has actually gone up over the past year, which is exactly what we want to see. But what's actually happened is that the Main Street inflation rate is still relatively stable. And unemployment is driven mostly by what's in blue, which is Main Street. That's why the unemployment rate has not ticked up to 3 or 4%, even if we're seeing tech layoffs and so many job cuts in the technology space. The tech space and Main Street are completely different things, and most of this inflation was driven by tech in the first place as people spent stimulus checks on buying goods, which is exactly the correction we want to see and are seeing over the past 12 months. You can't just look at the US unemployment rate and use it as a metric for whether or not markets have bottomed or the Fed's job is truly done. The US unemployment rate focuses on Main Street, which is somewhere you're not going to see job losses right now because it was not the beneficial sector throughout the pandemic. Stimulus checks drove spending on tech, not small businesses like your restaurants or your clothes shop or thrift store down the street. The bad news that we're getting from layoffs and potentially reduced earnings for companies is exactly what the market is currently looking for. Just because the market's rallying on bad news doesn't mean the market is broken. It means that the investment thesis for investors is shifting to the upside as they see market prices being undervalued compared to where fundamentals for companies are. And now the market's going to start focusing on the next thing, whether that be a war with Russia, a Ukraine debacle, or oil prices going through the roof. We'll have to wait and see what that's going to be for 2023. But so far, I have to see this inflation story is heading in the right direction. Things can obviously change, and I'll be covering that on my channel as soon as I hear about it. Let me know your thoughts down in the comment section below, and I'll catch you guys in the next one. Take care.